Hey, welcome to the daily stock review of Zevra Therapeutics. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years, and I'm sharing the lessons along the way. Here's my investing process. We'll cover today how I came across this stock and then the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves over just a little while, and by following the breadcrumbs they've left behind, should be able to follow in their footsteps. And if you like these free investing resources, the stuff that I wish I had when I first started, put them together for you. They're my gift. There's the link in the description, and it's free. Otherwise, let's get into it. Zevra Therapeutics. So over the last 12 months, it's kind of traveled a bit sideways, but obviously it's had a nice increase. Gonna poo-poo a 27% increase over a 5-year period. However, it's pretty well traveled sideways. It's had a lot of lows in here, down around the $4.60 compared to where it's at now, which is 11. And if we go back to max stocks, probably listed around 2015, had some pretty high hopes for itself. And then, bam, reality's kind of sunk in. Now, usually, this comes around from a business that's had amazing expectations. It's come out of the gate. It's pre-revenue. Whoop, whoop. But, it fails to meet investors' expectations for it. And that usually comes about because they either haven't hit milestones or they keep missing them. And in short, people that are willing to lock up money, a significant amount of money, and significantly overvalue that stock, well, eventually they want their money. And it looks like that hasn't happened for quite a while, over the last 10 years. So, looking at last 12 months, all that little bumping around is right here, where it's like pretty much dead flat. So it just shows you timing. When you're picking stocks, timing is a lot more important. If you're just going to own 100 stocks in an index, it doesn't matter. It takes in this variability. And usually, stocks like this don't make it into some of those indices as well. So you don't have this 93% loss over that period. You wait till they're a much more mature company when they make the indice. All right. However, if you're decide to jump into the game of picking stocks, it pays to know what to look for and what to watch out for, because this could be the fairy tale ending for a lot of the AI stocks, just like it was for the internet boom and stocks back in 2000, or from 99 through to 2001. You just got to be mindful of that. If stocks that are priced very high relative to their value don't start meeting expectations, boom, they can implode, just like this one. But is now the time? Well, it looks like it's much more sensibly priced. And let's start with how I came across this stock. So I'm looking at small caps in the health sector at the moment. So anything that's below 2 billion market cap. And this also on the screen is high revenue growth for the last 3 years, which is my top-down approach for looking at what's coming into the business. If it's starting to get revenues, it should be able to translate that to profits at the end of the day. And it means that it's kind of getting to the stage where it's mastered its customer. So businesses, especially like this, they can not produce money for quite a while, not be pre-revenue, for 10 years and then actually come good after everyone's forgotten about it. So, what am I going to do? I'm going to have a look at their 10K annual report because that's what we should do as investors. Literally take 5 minutes, first of all, to go and have a look at the stock's financials. We don't need to read an entire annual report to see if it's a good time to invest in the business. And just really, this is about seeing if it's worth looking into further. Because you can waste a shitload of time reading through an annual report only to realise this is a heap of shit and it's not worth your time at all, and to move on and find other better opportunities, or spend time with your family, friends, get outside, touch some grass. So what do we got? Revenue. 23, we're talking thousands. So 23 million up to 106 million in 1 year. Oh, nice, Gary. All right, what else we got? We've got total operating expenses. Whoa. You guys are off the charts. What are you doing? Impairment of intangible assets. Ooh. Okay. That's a problem. So that's a non-cash charge, so it doesn't affect the cash flow of the business. However, accounting requirements mean that it needs to put this on it if part of the business, it might have been a division that they've purchased in the past, is negatively affected. They've paid so much for it, and then that extra value hasn't been realised in future years. So that means it could take a hit, which means income goes down. What else we got? So loss from operations. So it's not even like operation margins. Like it's already wiped out all the profit that the core part of the business was making. Now, gain on sale of PRV. All right. So they've sold a portion of the business. And then that's the reason why they're in the black, in the red. I'll figure that out for next video. But they've made a profit. Boom. Previous year, 105 million loss. Obviously, a good sign is that revenues are increasing. And let's just have a think. So even if this impairment of intangible assets was out, which is a one-off, and it's non-cash effect, and if we take off this sale, the business still made a loss this year. So last year was 105. This year we're talking. Oh, well, we take away 150. We end up with minus 70. And then what do I have to do with this one? Well, it makes it look worse. All right. Well, actually, yeah. So anyway, not a really good look for the business because they started here at a 62 million loss. This is not a good part. But anyway, they're still operating at a loss. So is it something that we're really keen on at this present moment? Really, it depends how juicy the opportunity is. Because the stock isn't reflecting that the business is still making a loss. I mean, it's getting priced in that it's going to be potentially earning a profit. All right, let's have a look at the income or the balance sheet just to see if this business is in a healthy position, ready to strive for a bit of growth. What are we talking in? We're in thousands still. So it's got 284 million in assets. and 130 in liabilities. We've got a bit of long-term debt here. So 61 mil. What else? Total current assets is pretty high. So they've got a lot of cash equivalents on hand, which this big increase here in securities at fair value, cash and cash equivalents, has probably come about from the sale of that business. So that's all right for the time being. Let's just have a sticky beak at the cash flows and see if the management team are being rational with how they're spending the money. So we've got net income or loss. A net income figure comes out. We then got stock-based compensation that goes back in. We've got this impairment charge goes back in. And then we've got some adjustments. We've got a gain on sale of PRV. Interesting that they've put it as part of the operating activities. Usually they'd put it in terms of the investing activities. Because all that's done for me now is fudged my figure. So our net cash used in operating activities, we get down here. They've smashed through 70 mil in the previous year. So not good. And then in this year, well, we add that back on. So gain on sale of PRV, I wouldn't have put it in here. They've obviously tried to get that back to reality. The 83. So anyway, we end up with not really a good look. So we get our impairment charge put back in it, so that increases, but then it's pretty much wiped out by that. The actual gain on sale. Anyway, we end up with pretty much nothing again. Now, they're still on a spending spree. Purchase of equipment, disposals of property and equipment, and then purchases of investments. So 309 million. Maturities, proceeds from sale of PRV. Yeah. So, an interesting one. All right. So now, what are the long-term prospects? So from this, I'm not really too impressed. Is this business going to be able to be 100x? Look at the growth rate of the revenue. There's potential. It's obviously starting from pretty humble beginnings. PE ratio is fairly low at 11, which doesn't take into account the growth, but this business isn't making a profit yet. So this revenue still needs to grow to the stage that it is oversized compared to the total operating expenses, and it needs to be then bigger than all the rest of their expenses combined. So you've got a fair way to go just to get to that stage. Like I said, they're still at minus 70 if we take into account this gain on the sale of PRV, which is just subtracting that from their income statement. So these guys have still got a fair way to grow. When they do, it might be interesting for me to look at. At this stage, businesses still got a few risks there and a lot of uncertainty about their future. If you guys see it differently, let us know. It just means for me that I'll be coming back to this stock in the future. Like most of the ones that I go through, it's all about time and seeing if this business is not just going to do that again. But closer to where we are now. So it still needs to be able to finance the business, make money, and yeah, actually on that front, you know what, I didn't really see anything in our cash flow statement for what was propping up and financing the business. So what have they done previously? Because this year they just got all these sales from investments, etc., which propped the business up. That's how they finance the business. All right, previously they've got proceeds from issuance of debt, repayment of debt, proceeds from issuance of stock. There we go. Bada bing, bada boom. All right. So if I was you and you were in this stock already, probably not a lot you can do there. But what you want to see is mastery. Is the business mastering its customer? The moat is the moat of the business starting to expand. Now it's pretty tricky to look at that on a pre-revenue business because most of the time they don't have a moat. They're still digging it and building it, which all that moat is just a competitive advantage in the marketplace against its competitors. And think of, why would someone pay more for this product than just going elsewhere? Or can I only come to this customer and what's, the next best thing they can do? What else? And then management. Is management worth my time looking at? Because at the end of the day, if they're going to continue to issue more and more stock before they reach profitability and that revenue growth slows, they don't reach profitability in the next couple of years, then we've kind of got a problem where the business isn't going to be able to, prop itself up and finance itself. It's going to still need to go out, get more debt, get more shareholders to buy more stock. And at the end of the day, that's not a value-adding part of the business. So, if you guys have got an idea or you've been in Zevra for a while, let us know. And otherwise, check out this next video because YouTube thinks you'll like it. Cheers.